This is the charts on Kinder Morgan. Now, Kinder Morgan is a master limited partnership, and by law, it's required to distribute 90% of its profits to shareholders. And so that's what you get with Kinder Morgan. If we look at the monthly chart, we can see overall price has really been range bound for the past 8 or so years. So had you bought back in 2015, well, you're underwater. And anywhere in this range bound price action, well, you really haven't made a ton of money. So why has price been range bound for the past 8 years between $12 and $22? Well, let's get into this article, which will potentially give us clues. Is Kinder Morgan stock a buy? A lot has changed for midstream stocks over the past decade, and even more so for Kinder Morgan. If you are looking at this energy infrastructure stock today thinking that it has a reliable cash generating business, you need to consider it against other alternatives. Cutting a dividend is not something that most companies want to do, but sometimes it is the right choice. This was the case for Kinder Morgan in 2016 when it cut its dividend by roughly 75%. So there goes their grab to pull you in, or there was their grab, right? When they cut their dividend. This was done because management had to choose between paying the dividend or putting money to work in capital investment projects that would grow the company. There's been a lingering consequence from Kinder Morgan's decision to cut its dividend for investors as the midstream sector growth prospects have shifted. Prior to 2016, the sector was growing strongly thanks to material new investments. After that point, it became increasingly difficult to find new investment opportunities and growth slowed down. Investors reacted by moving on to more interesting sectors. At the end of 2015, management was telling investors that it would be able to increase the dividend by as much as 10% in 2016. Just a couple of months later, the dividend was cut. To earn back investor trust, management promised it would quickly grow the dividend, including a 25% hike in 2020. In 2020, the dividend ended up being increased by just 5%. It would be going too far to say that Kinder Morgan is a bad midstream company. However, there are better options out there. And looking at the chart from a technical standpoint, I'm in agreement. Now, if we scroll down to the weekly chart, we can see that we do have support down at the $16 level. Let's just expand that out. Resistance, support, 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 support. Let's take this line off. Now we can see that the moving averages are starting to crank up, and we're on the verge of getting a bullish crossover where the 13 crosses over the 26 simple weekly moving average. Going down to the daily chart, and we can see from the $16.20 level, we have a leg up. So the momentum is to the upside within this range bound price action. And you can see this past week, the $17 level, which is where the 200-day and the 100-day and the 50-day moving average all sit, served as support and push price up roughly $1. However, the chart suggests this is a dead stock, and so I would agree with the article. There are better opportunities out there. Thanks for watching. Subscribe. Please like the video.